Good afternoon, everyone. Thank you very much for joining us today. My name is Antonio Rodriguez. I'm a partner here at Procyon Partners, and today is our Procyon Perspectives Investment Committee webinar. So we're going to go through a few things today, and we're going to get into that in just a minute, but I want to introduce our panel that we have with us today. We've got Jeff Farah, who's joining us. He's a partner here at Procyon. Michael Desmond, one of our newest partners here at Procyon as well. We're happy to have him. And we're really lucky to have Joe Burns. He is a director and co-head of research at iCapital, awesome platform directly related to accessing alternative investments and lots of due diligence. So we're going to get into that as well. And before we kick over to that, we're going to talk today about alternative investments. So alternative investments are made up of lots of different things. And we're going to do a little bit of a deep dive on a couple of those. So first thing I'm going to do is actually put up a poll. I think that these interactive polls have become fun for all of us. And so this is an interesting topic. And so I think if I put this poll up here to begin with, maybe it'll give us an idea as to what we're going to be talking about. So I'm going to launch this poll here. So the poll says, which of the following would be considered an alternative investment? And you need to choose just one. Stock of a public company, A. B is bank deposit. C is commercial paper, and D, hedge fund. And so we'll kick it off with maybe an easy one here. I'm going to let that poll go for another minute, and then we'll talk about it. So why are we talking about it? Why alternative investments? Why not just stick with some of the classic investments that we've known over time in the public markets? There's a lot of different reasons for that. The main reason, though, I think goes back to an old idea in 1952, a paper written by Harry Markowitz. And ultimately that paper gave rise to something called modern portfolio theory. And modern portfolio theory suggests that diversification works. It suggests that you can combine a bunch of risky assets together and ultimately have less risk than any one of them. And so when you start to do that, you start to say, well, what's available for me? What can I start to invest in to do that? And of course, we wind up in the typical investments as we have. So as you start to derive some of these thoughts, I'm going to actually end the poll. I'm going to share the results as we talk about it, because I'm going to mention some of the answers as we go on. So it looks like the majority of us did choose hedge fund. A couple of us chose commercial paper, which I could see why that might be something you hadn't heard of, maybe something that's not typical, but commercial paper is a very liquid, highly rated piece of fixed income that gets traded on a regular basis. Thanks for taking that poll. So ultimately, what we want to talk about is not only how do these things work together, but how do you put them together in a way that's efficient? And we're going to get into that in a few minutes. But why do we need to put lots of different investments together? So if you have one investment by itself, it's going to be volatile. It has its own volatility. And if that's all that you own, you're going to own that investment and experience all the volatility. If you have another investment, that one has its own volatility and ups and downs and so forth. The idea is that when you put these two things together, you don't assume the risk of any one of them. As a matter of fact, you lower the risk when they're both put together. And over time, if you do that the right way, you can create a portfolio that starts to do what you want it to do and earns money over time. And the way that we start to do that and think about that, if you think about our last webinar, actually, we did something called 60-40 portfolio and beyond, which means that we've got traditional assets, and now we're thinking about what other assets we might need to use in order to fill in those gaps of lack of return. And so as we go forward, it's 60-40 or what have you, but the idea is diversity. So when you're diversifying, we're talking about risk management and possible performance enhancement. And so I want to show a quick chart that talks a little bit about that here. So this is, let me share my screen really quick so that you guys can see it all. There we go. So this graphic shows correlation of public and private markets. So a public market is shares of Microsoft or Google that we all aware of. A private market is maybe shares of a company you've never heard of or closely held company that has never gone public. And so what happens is, we talked about correlations last time, and I want to dig in a little bit on that this time. Correlation means what things move in the same direction at the same time. Now, that's not the same thing as causation, but correlation means if they tend to do that, then we can assume in the future they may tend to do that even further. If they move in opposite directions at the same time, then what we're going to say is, gee, if it does that over and over again, that those asset classes are negatively correlated. They move in opposite directions. And so what happens is over time, this chart showcases different asset classes and their correlations to each other. And so green is either neutral or positively correlated, whereas red is the opposite. And so when you look at, global bonds, what are they correlated to? Here are some of the correlations, -0.2, -0.1, and so on and so forth. And so on this scale, it starts to look like global bonds don't have a lot of correlation to other asset classes. So when you take that and you put that together with an asset class that maybe has some risk, you're able to lower your overall risk in the portfolio. Now, there's some problems with this. And over time, investors have run into those problems, and we're always trying to solve for those problems. One of the problems is a regulatory hurdle that we all have to deal with. So the SEC, which is our chief regulator, says that not everybody can invest in everything. And so we understand that. We think that regulations are good, and that we think that that's there to protect people, and we think it's important. However, we do think that there are times when an investor would like to gain access to an asset class that perhaps they wouldn't have been able to do that before. And so there are a few regulatory hurdles. One of them is for a lot of alternatives, anyone can invest in them. For some alternatives, you have to have $1 million net worth or higher. And even further than that, the SEC says for even additional alternatives, you need $5 million net worth or higher. And so when we're deciding how to do this with our clients, we're going through all the potential investments that would fit for someone in those different areas. And so essentially access has started to become more democratized. We're getting that, and Joe's going to talk about that. But ultimately, the SEC does dictate some of that. So we know that these aren't for everybody. But today, really, we're going to accomplish a deep dive on a couple of these asset classes. Alternatives can encompass everything from hedge funds to private equity to venture capital to commodities. Real estate, some real estate, very illiquid, large commercial real estate can potentially also be an alternative. Precious metals, everyone's talked about gold. Everyone wants to own gold. And even now, maybe we'll get into this, but this is what we're seeing is even digital assets are starting to become alternative assets in terms of their investment acumen. And so we need some history to figure that out on the digital side. But today we're really going to jump into three pieces of this: hedge funds, private equity, and due diligence. Because due diligence means what's the research you've done to figure out whether these things are real, how they're doing, and how we continue to make sure that they're doing what we expect. And that's why we have the team here. So Mike Desmond, I'm going to have you start here with us for a minute. I know you have a lot of interest, and you've talked to lots of your clients, as we have at the firm, about private equity. And if you wouldn't mind just giving us a little bit about a little info on that and taking a little bit deeper dive for us for the next few minutes.
Sure. Thank you, Antonio. So most investors are familiar with companies that trade on the New York Stock Exchange, the S&P 500, household names that everybody knows: Walmart, Apple. You can buy and sell these companies at any time. Investors have full liquidity. Investing in public equities, quite frankly, is dominating investor portfolios, and PE, private equity, conversely, is investing in privately held companies. And there really is a myriad of reasons why investing in PE makes sense. And Tony, you pointed out earlier that it is important to mention that investors should meet certain thresholds, right? You want to qualify for investing in private equity. So account value, risk tolerance, and time horizon should be considered. So I'm going to touch upon, why does private equity make sense? Some of the current trends that we've looked at, and statistically speaking, private equity, what does that look like today? So as far as investing in PE, better performance, historically speaking, private equity has outperformed better than publicly traded equities. And one of the benefits that we've seen that's overlooked is risk management. Now, private equity is less correlated asset class. You're not impervious to risk or losing money, but allocating private equity in a diversified portfolio makes sense. Private equity investments, certain private equity investments, may not be affected by the stock market movements. And as an investor, you're more tied to a company's performance. You're investing alongside entrepreneurs. Because if you think about it, you're buying stock in a publicly traded company, you're buying equity in a more established company. So private equity offers investors the opportunity to invest in the vision of an owner, the vision of an entrepreneur. And those type of investments can yield a higher return if they're chosen carefully. That's why we've mentioned it before. Manager selection is very important. Due diligence is incredibly important. I know Joe's going to talk about that later in the webinar. In fact, Joe, I want to give iCapital some credit. Your company put together a white paper on PE a few years ago. We've shared this with many clients. It's resonated with them. And I want to reference a graph from that white paper. But first, I'd like to pose a question. Antonio, if you could bring up that poll question, I really would like some feedback. So the question is, how many publicly traded companies? In the year, it's actually in 1996, there were a little bit over 8,000 publicly traded companies. How many publicly traded companies do we have now? 16,000, 20,000, 10,000, or 4,000? So let's think about this. 25 years ago, we had 8,000. What do you think the number is?
It's like, yeah, it's coming in. Wow, it's scattered pretty evenly distributed, actually, across those answers.
Okay.
Some at 20,000, a bunch at 4,000, a bunch at 16,000.
Okay.
Interesting. All right, we've got almost everyone answered. Okay, I'm going to end the poll.
Okay. You want to bring up the graph?
Why don't I share the results?
Yeah, please.
There you go.
Okay.
Looks like not everybody's going to get an A today.
All right, it's actually synonymous, with some of the feedback we have from our clients. Actually put up the answer. We'll let them see the answer.
Okay, great.
Do you see it?
Yeah. You see it there?
Yep, I see it. So in 1996, a little bit over 8,000, 8,090, and in 2018, 4,397. So the 4,000 crew had it. It's a little surprising, right? So I thought actually the number was a little bit higher myself when you take into consideration the amount of initial public offerings we've had in the last year and a half. But you have to ask, okay, why is that? So 25 years ago, when an owner of a privately held company wanted to monetize their investment, what did they do? They wanted to put together a private placement, seek out an investment banking firm, execute an IPO. That's how they would find liquidity. But in today's world, venture capital firms, private equity firms, are allowing owners to sell without going public. We've also seen a lot of mergers and acquisitions over the last decade, certainly consolidation. And clients that we actually have a desire to align themselves with strategic partners. We have a client that is looking to sell their business for 9 figures, and that is with a strategic partner in the same industry. So we know, A, that's important and that works. Reduced amount of regulatory requirements. Look at Michael Dell, publicly traded company, then went private. When you're trying to meet shareholder expectations quarter after quarter, it's certainly onerous. So some of the trends that we've picked up, we've seen is companies are staying private longer. By the time they go public, and if they do, most of the growth and value may be behind them. The average age of a publicly traded company 25 years ago was roughly about 12 and a half years. It's now 20. The other trend that we saw is that the percentage of revenue disseminated to research and development, R&D, that declined as well. Private equity firms, they're extracting a lot of value out of the portfolio companies before taking them public. We actually work with one of the largest private equity firms in the world. I mean, they're amazing what they do. They're completely dialed in. They work with the executive management team on a daily basis, so they would know the most advantageous time to consolidate or sell. And we also noticed that some of the stocks that have disappeared from the public markets are on the small cap asset class. And they typically generated high levels of growth than the large cap peers. So statistically speaking, what does PE look like today? And there's a couple of stats that jump out at me. Joe, you shared one with me quite recently, which I appreciated. There's over 7 million private US companies. There are nearly 200,000 US businesses with revenues between 10 million and $1 billion. So let's say the number is close to 5,000. You're looking at roughly 97.5% of these middle market companies are privately held. I mean, that's a huge, huge number. Now, the total assets on the management for private markets, and I'm talking private equity, I'm talking hedge funds, grew 5.1% to another all-time high. 7.4 trillion is in that space, and private equity is about 61% of that share, about 4.5 trillion. So in reality, we have a lot of growth, a lot of opportunity taking place outside of the public market. And the irony is a lot of institutional investors were gravitating, towards a passive index, an ETF benchmark to the S&P 500. I'm saying that, hey, just don't buy ETFs. Quite frankly, just don't buy private equity. I think the culmination of private and public would be certainly advantageous to consider.
Thanks, Mike. No, I think it goes to, MPT and the idea that you become less diversified if you just stay in public markets over time without having to really do much of anything. It automatically has happened over the last 20 years or so. So I appreciate that. That's a great insight. And it's, not something we talk a lot about, but when we do talk about it, it's important that we bring it up in this fashion. Jeff, we're going to have you go next and talk a little bit about the hedge fund area. Now, hedge funds are different in the sense that relies a little bit more on the strategy as opposed to the security. And so there's some due diligence and some other things that hopefully you can get across for us, and I know you will. So I'll kick it over to you, Jeff.
Sure. Thanks, Antonio. So what do most people know about hedge funds? Well, most people get their knowledge from watching Billions, or maybe they watch Big Short, right? So I'm going to try in a couple minutes today to tell you what they are, why we use them, and how we use them. So at its simplest form, a hedge fund is simply an LLC, a private partnership where the client, the investor, is trying to get access to a portfolio manager who has a unique skill, right? What they're trying to do and what we're trying to find is a manager who has skill, which they might also call their edge, and we might also call alpha. So they're uniquely positioned to be good at one particular thing. Then we're looking for the hedge fund manager to have a wide opportunity set for them to apply that skill. And then we want them to have the necessary time to execute that skill on that opportunity set. Not all opportunities are available at all times. So that's part of the art and the science to choosing the hedge funds. And there's lots of different kinds of hedge funds. Just to give you a quick, easy example, I'm going to explain what a long short equity manager would be like and compare them to a mutual fund. So if I'm a mutual fund manager and I like, say, Pepsi, and the way I make money for clients is I buy the stock and I hope that it goes up. That's the only way I make money, absent, the dividend. What a hedge fund manager would do if they like Pepsi was they'll buy Pepsi and they'll hope that it goes up. But they want to immunize themselves from the broad market movements, right? They just don't want to get the tailwind of markets going up or down. So what they might do is buy Pepsi long and sell Coke short. And selling short simply means that they would profit if the stock falls. So they have two similar investments that will profit in opposite directions. So if the market goes up, say 1%, they'll make money on Pepsi and lose money on Coke. Their return will be zero. And it will work the same way if the market falls. So what they're really trying to isolate is their investment thesis that in this case, Pepsi will do better than Coke. If it does, they can make money in both directions, right? And that's a key part of the hedge fund manager's general strategy, is to isolate their specific investment thesis and be laser focused on that thesis so that, they're not just catching tailwinds up or down as the broad markets move. And for global portfolio allocators like Procyon is, the ability to generate alpha and in a low or non-correlated way to the rest of a client's main portfolio is critical. That's kind of what we're looking for. So Antonio, if you could pull up the correlation slide, that would be great. And as I'll talk a little bit about why we use hedge funds. As Antonio mentioned, I'm using a client, the 60/40 portfolio. Could you go to the next slide, actually, Antonio? Yeah, this is a good one. So I'm comparing a hedge fund's correlation with a typical 60/40 stock portfolio. And for hedge funds, I'm simply using an index. What you'll notice here is a perfect correlation is 1, meaning they both move in the same direction. Hedge funds are typically lower correlated to the portfolio. And importantly, if you look at the blue circles, those are periods of market stress, government shutdown, tech bubble, global recession, financial crisis. And you'll notice the correlation goes to 0 or maybe even slightly negative. And that's kind of key for us. A hedge fund manager has the ability to be hedged and also to react quickly when market conditions change to hopefully give us that, that insurance. Thanks, Antonio. So if you could pull up my, my whiteboard slide, Antonio, that would be great. And I'll try to put my Professor Jeff hat on and show you a little bit about what we're trying to do with the risk and return. So this is a simple graph. It's showing, you know, return going up here and risk over here on the right. And let's say the only investments we have to choose from are stocks and bonds, which result in an ideal portfolio. Here, what we can do by introducing a low correlated asset that has positive returns by hedge funds, that gives the portfolio manager two good choices. We can keep the same level of risk for a client and get a better return, right? So that would be heading up here. If we are comfortable with the level of risk we are and want a more return, we'd head up this way. And if we want to add a risky asset like a hedge fund and make the return of the portfolio decrease, but keep the same return, then we'd be moving the portfolio out in this direction. So two good choices, either keep the return the same and do it with less risk, or the opposite, keep the risk the same and do it with the same return. So what that makes then is we don't want to own the portfolios that are inside here anymore, because we can have a better outcome for the client. All right, Antonio, if you could take that away, thank you. And then if you could pull up the dispersion slide of manager performance, I'll just talk a little bit about how important it is to do due diligence on a hedge fund, because as we've kind of talked about, we've eliminated the broad market movement and we've laser focused in on manager performance. So what this chart is showing you is a couple of different hedge fund strategies over the last decade or so. And the blue bar is how the average manager does. And what I want you to focus on is how big the bars are. The top quartile manager or the best managers are doing pretty well across the top, you know, 10, 11%, depending on the strategy. But the worst performing managers are at the bottom. They're barely breaking even or might even be slightly negative. So manager selection in alternatives and hedge funds is absolutely critical, or you'll be investing in something that's not going to deliver the performance that you're expecting. And Joe's definitely going to get into that in a second. And just to conclude, I would say, like Michael did, as a financial advisor or the Procyon Investment Committee is considering alternatives for a client, there's a lot of factors we need to factor in. Tax impact, are they tax efficient? Can the client, is the client okay getting a K-1 and maybe not filing their tax return on April 15th like they may be used to? What's the size of their portfolio? Client-specific factors on liquidity. How long can they tie up their money? The cost, hedge funds aren't cheap, right? You're going to pay, you know, 2 and 20 to access that very valuable non-correlating alpha. And then maybe the last question that would arise is if I do decide, or the client and I decide to allocate to a hedge fund, where's it going to come from? Which part of the 60-40 portfolio am I going to take the money out of? Is it the equity side or the bond side? You know, that may change over time, and it may also depend on what kind of a strategy you're going into. If I'm funding a long short equity manager, I might fund it from the equity side. Given where bond returns are right now, I might be funding it from the fixed income side. So there's a lot of complexity that is client specific that the individual advisors would need to talk to. So I'll turn it back to Antonio, and then we can hear from Joe about the due diligence and some other stuff. Thanks, Antonio.
Yeah, no, thanks, Jeff. That's really good, Professor Jeff. We appreciate the whiteboard usage. Brought us all back a little further than we had remembered previously, but we now are smarter. So thank you.
Actually, John Madden is participating on the webinar. He actually loved that illustration, by the way.
That's right. He signed up. So we're going to get into. We've talked already about a lot of stuff, right? What are some of the asset classes? What are they for? What do they do? But I think, as we know, as Jeff mentioned, the dispersion in manager selection is huge. It's not like buying an S&P 500 manager where, you know, they all are close within 0.5% of each other. This is a little different. And so there are some key pieces that are there, and not just for performance reasons, but for a lot of other reasons. And we'll let Joe get into it. But I'd like to introduce again, you know, Joe Burns, director, co-head of research at iCapital. And these guys are the ones that really dig into the back, do all the interviews and really figure out how this stuff works and do a lot of that work for us. So Joe, I wonder if you wouldn't, just for a couple minutes, give us a bit of a broad overview from your perspective on the alternatives world, maybe from a product perspective to start, and then we can go from there.
Happy to, Antonio. Thank you, and thanks for having me. And just want to make mention of the fact that it's been exciting from the iCapital perspective to see your firm grow across so many different dimensions, investment products, client growth. You guys just do an amazing job. So it's great to be here with all of you guys. And we've developed, I think, over the last several years, a really good working relationship. We're looking forward to continuing that in the future. Mike and Jeff stole a lot of my thunder. I mean, I think the guys, as it pertains to opportunities in private capital strategies and in hedge funds, it's very well covered. And, I think from a diligence standpoint specifically, if you think of a traditionally constructed portfolio, you have 3 decision points effectively, right? Well, how many public equities do I want to have versus, what my fixed income exposure should be? And these are all daily liquid instruments. They obviously serve 2 distinct purposes in a client portfolio. Within that, you'll decide, okay, do I want more growth or more value? Do I want more, international or US? Do I want large cap or small cap? Govies versus corporates versus high yield. So there's more decisions there. And then you pick the underlying instrument. And, there's not massive dispersion, certainly between the underlying securities, particularly in traditional fixed income markets. We have seen widening dispersion in growth over value or large over small or US over international. But by order of magnitude, it pales in comparison to the decisions that an advisor must make as it pertains to alternative strategies, right? First, do I want to invest in private capital markets? That could be private equity, that could be private credit. You're thinking 3, 5, upwards of 10 years of liquidity. So it is a long-term commitment on behalf of clients. Or do I want to invest in hedge funds that can be positively, or even negatively correlated to traditional markets? So that decision itself is extraordinarily important. Within those categories, you think about, okay, well, private equity, for example, do I want to invest in early stage venture or do I want to invest in late stage buyout? Again, massive dispersion of outcome, macroeconomic drivers. So that decision requires so much thought and so much diligence in terms of what are the inputs and what am I thinking of in allocating my client capital to an earlier stage or a later stage private company. And I think Mike did a great job sort of highlighting the massive size of private capital markets vis-a-vis what's available in public markets, particularly today in publicly listed equities. And then thirdly, and Jeff hit on this point, the dispersion of individual funds is extraordinarily wide. We talk a lot with advisors about the interquartile spread. And if you think of the narrow delta or differentiation in traditional fixed income, even across investment grade, high yield governments, municipal bonds, if you think of private debt strategies, the interquartile dispersion is between 500 and 1,000 basis points on a per annum. Hedge funds, as Jeff noted, between 10 and 15 percentage points, typically, between your top and your bottom quartile performance. And then private equity, it's more like 15 or 20%. So the diligence required to not only assess, okay, do I want to be more or less liquid within alternatives? Do I want to focus on earlier or later stage, higher or lower volatility strategies is another massive decision point in what the end outcome will be for clients. And then where the work really starts is from a sourcing, researching, and diligencing and monitoring standpoint. Well, what are the funds that I want to make available to my network of investors? Because again, if you make all of the right decisions in terms of asset class, sub-strategy, or you align yourself and your clients with the wrong fund, all of that work may be for naught because of that massive spread. And another point as it pertains to alternatives and really from a diligence standpoint, something we think a lot about. I think Jeff and Mike both made the point, the capital needs to be funded from somewhere, right? Yes, we have new clients that may have new capital to put to work, but traditionally, an investment has to come from somewhere to go somewhere. So what we see is what has transpired over much of the last 10, 12 years, really post the financial crisis of 2008, is that a traditional 60-40 construct, by and large, solved for the capital appreciation, solved for the wealth preservation, and generally speaking, solved for the efficient market theory of portfolio diversification. We did a study a couple of years ago that every time the S&P fell by more than 3% through 2018, traditional bonds rose. So you had that embedded negative correlation between stocks and bonds. The last 3 years, that's been very different. I mean, this month is another example where equities are down and fixed income is down. And that is starting to happen more and more. So that classic free lunch as it pertains to diversification by only investing in public markets hasn't been a bad playbook for much of the last 10 or 12 years. Arguably, what we've seen more recently, and I think, and I don't know, Antonio, how much you or your advisory team or your clients think about capital market assumptions. Some people think of them as valid in totality. Others may think of it as a little more like a crystal ball. The truth is probably somewhere in the middle. But Jeremy Grantham, who I'm sure, your whole team knows and many of your clients are probably familiar with, he's been thought of recently as a bit of a perma bear. He called this market the greatest bubble in his history. The only thing he compared it to, he's got a 50-year investment history, is Japan in the 1990s, because it's so pervasive, right? We're in an environment now, and it's not to say that it can't persist, but equities are arguably very richly priced in public markets. Bonds are clearly overowned to a significant degree. You can talk about the housing market, you can talk about other impacts from a macroeconomic standpoint, and then you start looking at alternatives. You start looking at strategies that are non-correlated, some of which are negatively correlated, some of which are long volatility. So in an environment where rates may go up, volatilities may rise, uncertainties may persist in terms of what happens next, bond tapering may at some point commence, the need to have this exposure in a client portfolio, and then the research to support, well, how are these decisions being made? Do I want to pick this private equity fund, or do I choose that hedge fund? The job of the advisor, and by extension, the role of iCapital, I think we do work very much hand in glove with our advisory partners, is, there's not only the attractiveness of the asset class, and I'll refer to alternatives erroneously for a second, just as an asset class, because it really isn't. But that on an absolute basis is very compelling right now, given some of the factors going on in the global economy, but also the opportunity set on a risk reward basis from traditional publicly traded stocks and bonds has, again, arguably never been quite as uninspiring, maybe, in terms of where we are today and what we may be looking at going forward. So, you have informational inefficiencies, you have an opportunity to apply a research and diligence process that adds exponentially more value in alternative strategies versus traditional in terms of that delta, that spread of where the capital may be put to work. So I think if taken together, there's a real opportunity now. We talked about the regulatory environment, the opportunity to access these funds at lower minimum investments with more transparency, easier use on behalf of the advisors. There's just this coalescence of factors that's really driving a lot of the demand towards alternative strategies, be they private capital, equity, or debt, or a number of hedge fund strategies also.
No, that's very good, Joe. A lot of good background and color there. I think it's important to recognize all of that. The public markets. Think about yesterday. Even here we are. Yesterday was a sell-off day. We hadn't experienced a lot of those over the course of the last year. That not too many. But yesterday we had rates rise. Bond prices are coming down, and equities were coming down at the same time. And so, at times of stress, as Jeff pointed out, some of these correlations that we talked about, whether they're valuation rich or not, some of the correlations go to one when you want them not to. And so alternative investments can provide an avenue where that doesn't happen potentially. And so you're right, dealing with the advisor, our investment team here spends a lot of time helping to assess and understand the risks that an investor can take. And when we're making the recommendation to own these types of investments, it's with all the things that you mentioned. I just had a couple of questions for the panel here for you guys for the last couple of minutes. I really appreciate that. Mike, I'll go back to you for a moment. When you're talking to a client about or an investor about the idea of using alternative investments as an allocation in their portfolio, what are some of the considerations? Joe mentioned volatility and this and that, but from the client's perspective, if you don't mind talking to us a little bit about some of the considerations that let's say a client would have to take into account that may be a little bit different than what you've discussed with them in the past.
Yeah, well, yeah, just to really break it down on a simple basis that, we're planning centric. We lead with the comprehensive financial plan always. So asset allocation, portfolio construction, although incredibly important, it's ancillary. So I would say that as a huge advocate for our clients and being fiduciaries, we really need to know about the other asset classes, because if there's a possibility to increase alpha and reduce sigma or risk, we certainly have to know about it. But we need to know first the goals, the objectives, what they want to accomplish before we even bring that into a suggestion.
Yeah, so it's no different, right? I mean, we're assessing goals, assessing time horizon, assessing risk. And, not every, 55-year-old potential retiree looks the same, right? So,
I mean, and Tony, you could have a $5-10 million account that will not qualify for private equity, or you could have $1 million that would be absolutely make a lot of sense. So it's just customized and it's contingent on the client.
Awesome. Jeff, quick question for you as well. What are some of the questions that you're hearing from clients when you bring these things up? I mean, this is different than other things that we do. Is it fees? Is it, liquidity? How is that dealt with, and what are you hearing from clients there?
Yeah, sure. It's important to make sure the clients have a good understanding. I would say fees are an upfront topic. If you want to get market beta, which is just simply the movement of the market, you can get that virtually for free. If you can provide consistent alpha that's non-correlated, that comes at a cost. And so we want to make sure clients understand, the 2 and 20 typical structure where the manager's participating and making most of their profits alongside you. Taxes, not every client is familiar with getting a K-1 and maybe having to delay their tax filing until the summer. So that's important, and that might be a deal breaker for some clients because they like getting their big return, even though you're not supposed to. They like getting their big tax return, and they want to file right away. The liquidity, I think that Mike mentioned, is huge. Most hedge funds you can get quarterly, annual liquidity, so you're not committing your capital for quite as long a period of time. Although you definitely want to go into it thinking like it's a long-term objective. The window is there. Private equity, you're committing your capital, like Joe said, for a decade. So not every private client has excess capital that they can target for a year. And quite frankly, that's why the private equity firms make a little bit of a liquidity premium, because if you are willing to tie up your money, you can get a little bit higher return. So I'd say those are the biggest factors, Antonio, is how you put the particular investment together. And then understanding, peeling back the cover. We're not going to talk specific products today, but peeling back the cover a little bit and making sure they understand exactly what they're investing in and what's a good scenario. What should that return profile probably look like for them?
Yeah, no, that's all good stuff to go through. And it's certainly a little bit different conversation than you might have, with a typical retirement person investing in stocks and bonds like we have for a while. So bringing those things up, for us, it's all about transparency. Obviously, we're fiduciaries, and so making sure we have those open conversations is paramount. Joe, I'll ask you one last question, if you don't mind. Kind of a bigger picture thing, and it's a little bit more speculative in terms of your answer, perhaps. But is there anything that you're seeing from a regulatory impact over the next, couple months that might change the industry or change some things? I mean, obviously, we're seeing potential tax increases. But I've also seen some potential changes to trust ownerships and so forth. So is there anything there that you would want to mention that you guys are keeping an eye on that we should also be paying attention to?
Yeah, I think a couple of things, Antonio. Certainly in a different tax regime, we're getting more inbound questions from advisors in terms of types of structures that make sense. It could be from a liquidity standpoint or different types of vehicles that may be more tax efficient relative to what may be available today. So there is I think a reasonable case to be made that that's going to be a secular opportunity and not necessarily one that's more cyclical in nature. So that's an area where we speak with, and we're in the fortunate position to have relationships with, many hundreds of general partners. So thinking about different structures as it pertains to taxable U.S. investors. I think, the markets are highly regulated. So, I do think one issue that's come up and continues to get a lot of press, and we think for very good reason, is the accreditation standard. You know, what, and you, Antonio, you made the point at the outset of the video here. Well, what types of strategies or structures should be made available to which types of clients, right? And we have clearly made significant inroads at, I'd say, democratizing alternatives, right? Making it more available to more people. Ultimately, there's a full alignment of interest between a company like iCapital, a firm like Procyon, and your clients that say, okay, well, we just want to be in a position to build the most durable, diversified, dependable portfolio that we can. And in so doing, let's have access to more vehicles and more structures, right? So it doesn't, like, let's not take all of the regs out of the equation, because it's very important that this maintains and is a regulated environment. Investors very much understand, you know, the liquidity, to Jeff's point, the liquidity, the fees, it's fully transparent. Everyone knows it, not only at the outset, but throughout the life of an investment. But I do think making more types of funds available to more investors, they could be a qualified purchaser, they could be an accredited investor, it could be a sub-accredited LP, I think is just, again, a trend that is likely to continue. Ultimately, that's to the net benefit of the underlying clients, particularly in an environment where alternative strategies are adding significant value versus a traditional only asset allocation model.
Yeah, no, I think that's a great spot to end, Joe. We do appreciate, you know, Jeff, Mike, Joe, thank you all three for joining us today and giving us your time. We hope that all the viewers enjoyed this. We thank you for joining us today. We're going to continue to do this on a quarterly basis. If you have any questions, please, you know, reach out to your advisor, reach out to Procyon. We'd be happy to answer them for you. And above all else, have a great week. Have a great weekend. Take care.